Imagine taking exactly $100 and putting it into each major crypto coin at the first month, where we have reliable public market data. Then imagine doing the hardest thing in investing. Absolutely nothing. No perfect top selling. No panic selling. No switching coins every week. Just $100 left alone while the market goes through hype, crashes, scandals, recoveries, and new cycles. The bars you see are not raw coin prices. A coin priced at $1 is not automatically better than a coin priced at 60,000. The bars show what that original $100 would be worth over time. That makes the race easier to understand. The question becomes simple. Which coins rewarded early patience? Which ones only looked powerful for a moment? And which ones punished late belief? Watch the chart carefully, because the winner at the peak is not always the winner at the end. This method also exposes a psychological trap. People usually hear about a coin after it has already moved. The chart starts earlier than public excitement, which is why some returns will look almost impossible compared with the experience of normal late buyers. At the start of this data set, Bitcoin is the reference point. It has the clearest story. Scarce digital money, independent from banks, protected by a large mining network. Litecoin follows with a similar pitch, faster blocks, and a lighter brand. XRP approaches the problem differently, aiming at payments and financial institutions. Dogecoin begins as internet humor, but that joke becomes a surprisingly durable community. Monero enters with a privacy-first identity. These early coins matter because crypto markets were still small. A few exchanges, a few online communities, and a few big believers could move prices dramatically. That creates the first lesson of the video. Being early can create extraordinary upside, but early markets are fragile. Liquidity is thin, rules are unclear, security is uneven. A small investment can multiply fast, but the same market can fall brutally when attention disappears. In traditional markets, a large asset usually needs massive money to double. In early crypto, small flows could reprice an entire coin, which is why the early bars can move with unusual violence. Ethereum changes the shape of the race because it changes the question people ask about crypto. Bitcoin asks whether digital scarcity can become money. Ethereum asks whether blockchains can become programmable infrastructure. That difference matters. Suddenly, a coin is not only a bet on price, it is a bet on developers, applications, tokens, decentralized finance, NFTs, and network effects. This is why Ethereum becomes one of the most important characters in crypto history, even when its early monthly history is less complete in some public data feeds. Its story pulls the whole market into a new phase. Investors are no longer only comparing digital cash projects. They are comparing platforms. A platform can grow through usage, speculation, and the promise that other projects will be built on top of it. That promise becomes powerful, but also dangerous, because many platforms later overpromise what they can actually deliver. This is also when crypto starts borrowing language from technology investing. Ecosystems, users, fees, developers, adoption. Those words sound serious, but the prices are still driven heavily by expectations. The 2017 boom is the first moment when millions of normal people hear about altcoins. Prices rise so quickly that the chart starts to look unreal. New tokens appear everywhere. White papers become marketing documents. Initial coin offerings raise money with very little proof that the projects will survive. Then 2018 arrives and the market teaches the other side of exponential gains. Many coins lose most of their value. Some never return to their old importance. This is where a chart race becomes more useful than a final ranking. A final ranking tells you who is large today. A race shows how painful the path was. If a coin falls 90%, it needs a 10 times gain just to recover. If it falls 99%, it needs 100 times gain. Crypto rewards timing, but it also punishes weak conviction and weak projects. The crash also changes behavior. After people experience a full cycle, they stop asking only how high a coin can go. They start asking whether it can survive the next winter. The quiet years after the crash are usually ignored, but they are where the next cycle is built. Prices look boring compared with the mania, but infrastructure improves. Exchanges become larger, Stablecoins become more important. Wallets improve. Custody solutions become more professional. Developers keep building even when the public has moved on. This matters because a coin that survives a quiet market is different from a coin that only survives during hype. In these years, Bitcoin strengthens its digital gold identity. Ethereum keeps attracting developers. Some older altcoins remain visible because their communities continue to exist. Other names slowly fade. For viewers, this is the part of the video that separates a pump from a market. When the music stops and attention leaves, the coins still moving in the race are the ones with some combination of liquidity, story, and persistence. This is why boring periods deserve screen time. If a coin holds attention only during a bull market, it is probably not as strong as its peak suggested. Then 2021 turns the market into a global spectacle. Dogecoin explodes from a joke into a mainstream asset discussed by celebrities, influencers, and ordinary retail traders. Shiba Inu arrives with even more extreme percentage moves. Solana, BNB, Polygon, Avalanche, and other networks rise because investors want faster chains, cheaper transactions, and the next Ethereum-sized story. NFTs bring millions of new people into crypto culture. DeFi creates the feeling that finance itself is being rebuilt online. This is the emotional center of the video. The dream is visible. A small $100 bet can become shocking money. But the warning is visible too. When a bar moves almost vertically, the risk is also vertical. Many buyers do not buy at the first tracked month. They buy when the chart is already screaming. The same coin can make early holders rich and late buyers miserable. That is the uncomfortable truth of percentage return charts. The return is real, but most people only discover the opportunity after the easiest money has already been made. The 2022 crash is different because it exposes structural weakness. Not only overvalued prices, Terra collapses, major lenders fail, leverage unwinds. FTX goes from a symbol of crypto success to one of the biggest trust failures in the industry. The damage spreads beyond the failed companies because crypto markets are deeply connected through liquidity, collateral, and confidence. Even coins that did not cause the crisis fall because traders sell what they can sell. This is why risk in crypto is broader than the coin itself. You can study a project, believe in its technology, and still be hit by an exchange failure, a lending collapse, regulatory fear, or a global liquidity squeeze. The chart makes that clear. During contagion, strong names and weak names often fall together. The difference appears later, when only some of them recover. This is also why custody matters. A profitable investment means nothing if the exchange holding it disappears. After the crash, the market begins sorting survivors from memories. Bitcoin benefits from the clearest identity and the deepest liquidity. Ethereum benefits from its developer ecosystem and the amount of activity built around it. BNB remains important because exchange ecosystems can create persistent demand. Solana and other high-speed chains try to recover credibility after outages, drawdowns, and changing narratives. Meme coins continue to move, but their fuel is attention, and attention is unstable. This period is less spectacular than the boom, but it is more informative. The question changes from how high can this go to why should this still exist? Coins that can answer that question tend to stay in the race. Coins that depended only on the previous cycle's excitement often remain far below their old peaks. Survivorship can be misleading though. The chart mostly shows coins that still have usable data today, so the graveyard of failed coins is larger than the screen can show. The latest part of the race shows a more mature crypto market. Bitcoin spot ETFs make it easier for traditional investors to get exposure. Regulation becomes a bigger force. Interest rate expectations matter more. Large institutions, retail traders, miners, developers, and exchanges all push on the market at the same time. But the chart still carries the same message from the beginning. The biggest long-term gains usually came with brutal volatility. Holding through a huge winter meant holding through crashes that looked fatal in the moment. A $100 investment could become life-changing money, but only for people who survived long periods of doubt, boredom, and fear. This is why crypto charts are emotionally powerful. They show money, but they also show patience under stress. As the market matures, the easy 1,000-times stories may become rarer, but the emotional cycle of greed and fear has not disappeared. So, who really won this race? There are several answers. One coin may have the biggest peak. Another may have the strongest final value. Another may have survived the most cycles with the least damage to its reputation. Some coins produced unbelievable returns for early holders, then trapped late buyers near the top. Others looked boring during the mania, but proved more durable over time. The clean lesson is that crypto history is not easy money, moving in a straight line. It is a sequence of narratives, liquidity waves, crashes, scandals, recoveries, and survivorship. A chart like this can show the winners and losers, but it cannot remove risk. Used correctly, it teaches skepticism, timing, diversification, and humility. The most dangerous moment is usually when a coin looks obvious to everyone. If you remember one thing, remember this. Every giant bar on this chart required someone to hold through moments where quitting felt rational. That is why the result is impressive, but the journey is the real story.